Hello, thank you everyone for joining the webinar today. My name is Michael Hansen, Program Manager with the Action Innovation Network. Action is a collaborative network of technology business incubators and other entrepreneurship support organizations located throughout the New England region. Our network supports startups developing technologies across a wide range of tech industry sectors, including life sciences, clean tech, robotics, ocean technologies, advanced materials, and others. Our Plymouth Rock project provides a suite of resources for international startups that are interested in expanding to this innovation ecosystem and grow their company in the US. A few items to review before we start the presentation. All attendees will have their audio and video muted. Please submit your questions during the presentation by clicking on chat and submitting your question through the chat window to the presenter. This webinar will be recorded and emailed to you and also posted on our website for future viewing. Today's webinar is presented by Sandra O'Neill, partner at law firm Bowditch & Dewey. Sandra is an established tax attorney at Bowditch & Dewey, advising clients on federal income tax matters and corporate mergers, acquisitions, joint ventures, planning initiatives, including the structuring of cross-border and intellectual property buy-in transactions. She also assists clients with partnership and real estate investment trust tax issues in the formation of real estate investment funds. Thank you for joining us today, Sandra, to present. We're looking forward to your presentation.
Great, thank you, Michael, and welcome. It's nice to see everyone at 9 on a Thursday. And, you know, I would like this to be interactive. I have some slides to go over, but then please feel free to ask questions you have about tax considerations for doing business in the US. What I will go over in this presentation is first structuring operations in the US. One thing you have to remember, the US is a federal system of laws, and so both federal and state laws govern operations. And when you do business in the US, you know, you need to think about what state you plan to operate in. And different states have different compliance rules, and they also provide different tax incentives to operating. I'm going to go over tax compliance as well, generally, you know, what general forms and reporting requirements you need to think about from a tax perspective when you're doing business in the US, and some intellectual property rights incentives that the US now provides to tech and other entrepreneurs doing business in the US. So first, an overview of US legal structures. The main structures that businesses use to operate in the US are limited liability companies and also corporations. And both limited liability companies and corporations provide limited liability to investors, which means that you are only liable for your capital investment to the business. And they can't go after you personally for any liabilities of the business. A corporation has a traditional structure. There are shareholders, a board that approves major decisions, and then officers that execute decisions and approve sort of day-to-day decisions for running the business. A limited liability company provides significant flexibility to operating. You don't need a board, for example. The business can be member managed, but you can set up a board. So it really sort of can offer you any type of management structure you prefer. A corporation files a corporate tax return and pays an additional corporate tax. So that's sort of one, you know, big monetary point that you need to think about in setting up a business as a corporation. An LLC is taxed as a pass-through and a partnership if you have more than one member. But that does make compliance a bit more complicated because The LLC has to file U.S. federal and state tax returns where it operates, but also members in the LLC have to file returns in the states in which the business operates. So it can create a fair amount of complexity for compliance. Okay, there we go. So given that the LLC is a pass-through, there is generally no extra dividend tax to foreign investors. There's one level of tax. That is not the case, however, if a foreign corporation establishes a U.S. LLC. Then there are what's called a branch profits tax. So, that's something to think about. A corporation, however, will charge a withholding tax on dividends paid to foreign investors. So there is an extra layer of tax. And this tax is typically reduced by treaty, depending on where the foreign investor resides. So for example, the typical US dividend withholding rate is 30%, but if you're in the United Kingdom, there's a treaty between the UK and the US, and that typically reduces dividend taxes to 15%. And so, with respect to the tax on the business, the US corporate tax rate is currently 21%. In the pass-through structure, the income is taxed at ordinary income rates, which are currently taxed at 37%. However, certain qualified businesses that are active trader businesses that are not service businesses can now receive a lower tax rate of 29.6%. And any capital gains of the LLC are taxed at a reduced rate at 20%. So since 2017, when the tax rate for corporations was reduced to 21%, that has made corporations in some ways more competitive from a structuring perspective, because there isn't that much difference if you're planning to reinvest in the business between the tax on the corporate profits and getting that capital gains rate for individual rates or the qualified business tax rate. In addition, there is, the Biden administration has proposed to raise the top individual ordinary income and capital gains rates both to 39.6% and to phase out the lower qualified business rate for pass-throughs. The Biden proposal, however, only proposes to raise corporate tax rates to 28%. So that does seem to make corporate operations more competitive still. And given that, I will say that in most instances, non-U.S. investors typically establish U.S. corporate subsidiaries to engage in business in the U.S. As I mentioned, because the corporate tax rates are relatively low. And since there's only one corporate tax filing, that minimizes the tax compliance burden for the foreign investors. And you still get the limited liability by actually setting up a corporate subsidiary rather than, say, just starting to engage in business without setting up a subsidiary in the US, where that can subject the foreign investor to more liability than the investor's investment. So now I'm just going to go over the compliance requirements for a US corporation. From a federal perspective, a corporation will file an annual Form 1120 corporate tax return. The corporation will also have to file state corporate income tax returns in the states where it operates. And then if it has employees, there are quarterly federal and state payroll tax returns. Typically, companies outsource these returns to sort of ADP, a third-party service provider. If there's dividends or payments between the corporation and foreign owners, the corporation has to file federal withholding tax returns quarterly. And then if there are sales by the corporation, depending on the state, you have to file also quarterly state sales and use tax returns. And if you have property in different states, you will have to file local property tax returns. So there's a myriad of tax filings, and something to consider before you embark on business in the US and sort of think about expanding also within the US. In addition, you have your typical legal filings. If you set up a corporation, you have to make a filing with the Secretary of State every year. And then wherever the corporation does business, you also have to make filings. And also, typically, most businesses do use third-party providers for those filings. From the tax filings, you certainly, typically you hire an accountant, but there aren't as good, in my experience, sort of automated service providers that will just take care of the filings for you. So it is a more manual process. So now I'm going to just talk about, some incentives that the tax system provides to corporations, in particular to tech and other IP businesses. The 2017 Tax Reform Act reduced the tax rate on so-called foreign-derived IP-generated income. And as I mentioned, the US corporate tax rate is currently 21%, but this foreign-derived IP income was reduced to 13.125%. After 2026, the rate is going to increase, but only to 16.4%. And so this rate applies to, say you're a software business and you sell or license software overseas and you develop it in the US, any income from those foreign sales will be taxed at this lower 16.4%. So, it's really a very competitive rate now. You may have heard that, in the past, typically businesses would set up IP companies in Switzerland or Ireland because they had reduced 16% or 10% rates. And I think in some ways the US wanted to take back that business. And so this IP reduced rate has made the US more competitive for locating your IP and doing your intangible research and development in the US. And interestingly, Biden's tax proposal does not eliminate this tax benefit. So, even with the increased rates, if there's a tax bill that does pass, it's not anticipated that the corporate reduced rates or generally the reduced rates for foreign-derived intangible income will be repealed. The US also has a very significant federal R&D credit, which is available for R&D expenses. And it's broad. You don't have to sort of develop a unique idea. It's claimed by a tax-paying business that develops, designs, or improves products, processes, formulas, or software. And startup businesses can qualify for up to 1.25 million of the credit to offset employment taxes, FICA taxes. So it's limited to direct wage, supply, and equipment research expenses, and a specific percentage of contract research expenses. And it's not allowed for indirect administrative or overhead expenditures. And so what's important for both, this credit and also, quite frankly, the foreign-derived intangible income tax rate is being able to track the income and expenses. And, often what you might see is a company sort of doesn't really track the expenses because it is complicated. And then at a later date might hire some accounting firm to go in and do an R&D credit study when they become profitable to be able to take the credit. But those studies are costly. So, I think if you can go in and work with an advisor and sort of think about ways to track the expenses from the start, first, if you're a startup, you can get the credit and use it to offset payroll taxes. And second, then you don't have to, at a later date, go in and hire someone to do this big R&D credit study. Likewise, the foreign-derived intangible income tax benefit you know, it's, as I understand it now, the general tax software that's provided does not automatically calculate this. So, you know, it's not something, I think if you're a business and you track forward sales, I mean, it's something where you can easily access the data, but it is something that you need to sort of look into and, you know, quite frankly, even just have a manual Excel process to keep track of it, so that you can get that tax benefit once you're profitable. And, you know, like I said, we're a federal tax system, so there are also state tax incentives, in particular for often for technology firms, for R&D and manufacturing. Massachusetts, where I practice, right now has focused significantly on life science corporations, and there's a whole web of credits and incentives for Massachusetts life science jobs created in capital investments. You know, if you're a Massachusetts Life Science Corporation, if you qualify like a biotech, pharma, and you plan to create jobs in Massachusetts, you can actually get a credit, even if you are running losses, a refundable credit for jobs that you promised to create in Massachusetts. So that's something also worth considering. Massachusetts manufacturing corporations also receive significant tax benefits, reduced income tax, sales and use tax exemptions for property purchased and used in manufacturing or research and development, an investment tax credit for newly purchased machinery that can be used against the company's Massachusetts corporate excise tax, and an exemption from local personal property taxation. So that's a great qualification, and manufacturing is defined broadly and includes software development. So it's something to note. Finally, I do want to talk a bit about, you know, some challenges when you're operating cross-border. I mean, listen, the U.S. tax rules are very complicated, and it's easy to spend significant dollars on tax advice. And one area that often can pose a challenge if you have cross-border operations are transfer pricing rules. So say I once advised a Canadian startup and they were also doing business in the US, and you know, then you have to decide how to allocate income and losses, both to, you know, the home base and the US. And, you know, I think one thing to consider, especially if you're a startup and running losses, is often an advisor might tell you, well, in the long term, you're going to be profitable. And so, you know, you want to have the profit entity be one jurisdiction, and then typically what happens is the other jurisdiction you treat as a service provider, and they operate at cost plus, and they're basically profitable from the start. But you know, in my experience, if you're a startup, you don't really want to pay income taxes for income that doesn't exist. So, you know, I think there are ways, if you are an entrepreneur and you are doing business in multiple jurisdictions, you can, for example, use profit sharing and sort of say, okay, well, I'm doing business in both jurisdictions, and therefore right now we're running losses in both jurisdictions. And once the business becomes profitable, then you'll share the profits. And that might be easier, you know, rather than doing some big transfer pricing study and you know, thinking about what type of service, you know, one jurisdiction is providing to the other. If you are doing business in multiple states, now under recent case law, even if you have no presence in a state where you, you know, sell product, you must charge sales tax to the customer residents in the other state. So that's something to consider. And that was a recent Wayfair case decision where that decision was made. And then likewise, you know, now with our more remote economy, if you have employees in multiple states, you have to consider the cross-border employment tax rules, and that, you know, if you have an employee residing and working from home in one state, you will need to withhold state income taxes in that state. And potentially file, quite frankly, corporate income taxes because you're considered doing business in that state. So, you know, given the complexity of the rules, I definitely recommend I mean, you'll need an accountant, you'll need someone to prepare your returns, but it's worth getting an advisor who sort of has experience with multiple areas of taxation, so the advisor can spot multiple issues and provide practical advice to help you manage your business. And I guess now I just, that's really it, and I'd love to turn it over for questions.
Thank you, Sandra. Are there any questions for Sandra? Please submit those using the chat window. Okay, so one question, Sandra. Does the foreign-derived IP-generated income, does that refer to sales of products outside the U.S.?
Yes. So it's both sales or royalties if you license product outside of the U.S.
Okay. So okay. And is the R&D tax credit eligible for services, or is it just for products?
If you are in sort of doing R&D on processes in services, you can take the credit there. So it is pretty broad. It's, if you're sort of researching a process to provide a better service, it's possible that will qualify for the tax credit.
Okay. So research done on designing or improving a process that's related to a service.
Correct.
That would be okay. Okay. And next question: is there any difference when we do an acquisition versus open a U.S. business for taxes? And then follow-up question: anything to pay attention to from a Canadian perspective before doing the acquisition for tax issues?
Well, opening a business, you need to think about the legal structure of the business. So, I think as I mentioned, likely you would want to you need to hire an attorney to sort of set up a corporation for you to do that business where you plan to be based. When you acquire a business, you need to look at also the legal structure. And I think typically if you're acquiring a business from Canada, you probably do want to make sure the structure is that of a corporation. So if you're looking at a business and it's not, probably what you would want to do, however, is if it's not a corporation, you want to acquire a pass-through, get the assets. So then you get a step up. That's typically what you want. And then you can start amortizing the goodwill, and you get a tax deduction for that. But you want to structure the acquisition so immediately after acquiring the business, it's put in a corporate solution, so that you don't have to worry about all the multiple filings that result if you're a Canadian company and you own a pass-through. As for specific Canadian U.S. considerations, I think, again, I would say on the U.S. side, what's best is if you can structure the acquisition so it is an asset purchase from a U.S. tax perspective, and then you can get the amortization deduction over time. So that's really what you want to look for. From a Canadian standpoint, I would defer to Canadian tax lawyers. I know there are sort of some tricky rules in Canada, but that's a nice structure too. I will say, if you have the Canadian parent and the U.S. sub, the U.S. has all these rules for foreign subsidiaries that make operating foreign subsidiaries quite complicated. So in my experience, it's better I think, to have the foreign corporation do the acquisition and be the parent, but you might want to consider doing your research and development and everything else in the US now, because, I mean, just because of these tax benefits and the reduced tax rate for foreign derived intangible income, which I think is lower than the Canadian tax rate, which I believe is like 26%. So that is what I can say.
Okay. All right. Thank you. The next question, if you have a business partner in the US and based out of Germany, does it make sense to incorporate a company in Germany and then create an entity in the US, even though the primary market is in the US?
So let me see, a business partner in the US, and I'm sorry, could you repeat the question?
Yeah, so if you have a business partner in the US
Yep.
and based out of Germany, does it make sense to incorporate a company in Germany and then create an entity in the US, even though the primary market is in the US?
I think on the German question, I would defer. This is the challenge with cross-border work, is you're going to need advisors in multiple jurisdictions. But I would defer to the German advisors that if the business partner is spending significant time in Germany, if you need an entity there. I mean, typically in my experience, if they are, you probably do. But again, I would defer to the German advisor. But here, I think, again, my advice when you have these cross-border businesses is to, I mean, I think the US, again, now more and more provides a competitive rate, certainly vis-a-vis Germany, for operations. And I think you just need to think through as to how you want to structure it. Is the money going to always just go directly from the US to the shareholders? You're going to need to think about those considerations when you decide whether the German entity should be a subsidiary of the US business, or can it be the parent, or should it be brother, sister? I mean, there's just a lot of questions to consider as to how you're going to structure those operations. So.
Right. And so I think an important, takeaway there is that other countries have tax laws governing doing business outside of that country. And so you have to have good understanding of what those tax laws are in the other countries, as well as what the US laws are doing business in other countries. So, okay. And what is an example? So you mentioned indirect expenses for which the R&D tax credit is not allowed. What would be an example of an indirect expense that's not allowed?
I mean, just like overhead, if you have corporate sort of administrative payroll, you're not going to get a credit for that. You have to, the R&D credit is specifically for wages paid to employees who work in research and development. You have to track those people and their payroll. But you can't sort of say, okay, well, my corporate executive, he was involved in an R&D project, he's going to get to take, I'm going to track his payroll and take a credit for that. That's not allowed. So that would be one.
Okay. Okay. That's good to clarify that. And regarding the transfer pricing rules, would forming a U.S. subsidiary simplify the challenges that are associated with the transfer pricing rules?
Unfortunately, no. I think that, well, yes and no. If you don't have a subsidiary, it's possible that the IRS might say, oh, you're doing business and some of your income, you know, if the US people were crossing borders to Canada and or wherever, that some of the income that is in Canada should be allocated to the US. But quite frankly, it's not the, I mean, they can come in and sort of question if you're running losses in the US, but you're very profitable in another jurisdiction. You know, they could say, well, actually, you know, the US should get some of those profits. So the best way to sort of back up your transfer pricing is to think about what you're doing in the US versus what you're doing in the other country. And, you know, the whole transfer pricing methodology is, it's based on this idea that in each jurisdiction, you're arm's length. So let's say you're doing all the R&D in the US, you know, the US is probably going to say, but, you know, you're not profitable in the US, but you're very, very profitable in Canada. The US is going to say, I want some profits in the US. So you need to sort of think about, well, how do I want, you know, what do competitors, if let's say you want to just limit profits in the US, you could say, well, I'm going to look at other R&D companies that contract out R&D, look at their profit margin and say, okay, I'm going to limit the margin of profits allocated to the US and the excess profits will be in another jurisdiction. Or, I mean, quite frankly, I think the most simple is to say, we'll just split the profits. That, you know, if I'm doing a lot of R&D in the US and I'm doing sales in Canada, really we need both businesses to sort of run things. So I'm just going to split the profits across the US and Canada. But it's complicated. It's not easy.
Okay. Okay. Thank you. Yeah. So again, I think the takeaway there is that you need to have good tax counsel that's has insight into the rules that apply in the different jurisdictions where you're operating.
Yeah, and you need to, you know, quite frankly, it's important to have good data. I mean, you need to know how you run your business. You need to know, you know, where your people are and what they're doing. So in some ways, you might see this as a tool to just manage the financial aspects of your business anyway. Because once you know that, then you can consider how profits and losses should be allocated.
Okay. And you touched on this earlier so with more employees working remotely, how does that impact where the work is being done, where it's determined work is being done?
Well, you know,
if they're in different states.
Yeah, if they're working remotely and they're in a different state, then that is where the work is considered being done. And right now, you know, states have issued these sort of COVID reprieves where, you know, Massachusetts has said, for example, if you're working out of state, they will not require the corporation to file tax returns and allocate income in that state from a corporate income tax perspective. However, from a payroll tax perspective, you still probably need to withhold payroll taxes in the state where the person is residing. And I had one situation where a client came and they worked for a law firm, actually, and they were based in California, but they had come to Massachusetts to stay during COVID. And the challenges in the different states, they actually have different rules for residency. So quite frankly, she could be viewed as a resident both in California and Massachusetts. And so the firm had said, we're going to withhold payroll taxes in both states, which is kind of crappy because it's double withholding. Granted, she would get a credit because you can allocate. I mean, you have to think about the days and the time where you are residing. So she wouldn't pay double tax ultimately, but it would be on her withholding. And then, the challenge though in that situation is if you have intangible income, investment income, you actually might pay double tax. So, the state tax rules, a lot of them do not overlap. They're not the same. So if you have remote employees in different states, it can be a significant administrative burden. So I know that people have been talking up, oh, this is so great, everyone can work everywhere. But the reality is for the employer, it can become a significant hassle if that's happening, because you will have to withhold and have sort of, administrative capabilities in those different states. So that's something to consider.
And then also in that type of situation, the employee might, like with the law firm in California example, the employee might have to file a return in a state that they wouldn't normally need to file in order to get that credit back from the additional withholding. Is that right?
Yes, you will have to file double returns, and quite frankly, that's also time consuming, and you might not be aware, so you'll need a good accountant to get those returns done.
Right. Yeah, that's really interesting. So that I think is going to be a widespread issue, because there are so many people working remotely now for most companies, and people have in some cases, because of the COVID pandemic, they've chosen to move to different to other places, maybe to be close to family, so they might be moving to a different state and working remotely.
Oh yeah, and you have companies now like Facebook, they're saying, oh, we're going to let everyone work remotely. And maybe for Facebook, that's not a big deal. It's a huge company. I mean, quite frankly, Facebook will probably have to file tax returns in all the states where its employees are working. They might do that already, but that is a hassle. And if you're a smaller business, you might want to think about, if you're offering that benefit, whether it's really worth it, because you will have to face those administrative hassles, because our tax laws, just quite frankly, they really haven't kept up with the technological changes of the century. I mean, they're based on a completely different economy, more of a manufacturing economy. So it's very challenging for sort of entrepreneurs, tech type businesses to have to deal with the older tax laws.
Right. Yeah, and different states, they have their own tax laws. So
yes,
so that adds complexity and understanding the tax laws for each state.
Yeah.
that you're operating in. Or okay, very helpful. Are there any additional questions for Sandra? Okay, I don't see any additional questions. So thank you very much for your presentation today, Sandra. It was very informative.
Great. No, you're welcome. This is fun. So, and have a good day. And, if you have any sort of tax questions, please feel free to reach out to me. I definitely have had a lot of experience advising, startup businesses that want to do business in the U.S. as well. So I've seen a fair amount of issues.
And I believe you have a slide with your contact information.
Yes. Share my last slide.
Okay. So there's contact information if anyone would like to reach out to Sandra directly. And thank you everyone for joining us today for this webinar. We hope you found this informative. Please check our website for upcoming webinars that we will be scheduling at actionnewengland.org. And thank you everyone. Have a great day.
Bye. Thanks.